Most Bitcoin traders get wrecked for one simple reason. They're only looking at one piece of the puzzle. They spot a bullish pattern on a chart, jump in head first, and risk their capital on a single isolated event. It's like driving blind. Sure, you might get lucky once or twice, but over time, you get stopped out, liquidated, and absolutely burned by whales and sudden market shifts you never saw coming. It's a frustrating cycle of hope and loss that forces most people to just quit. But what if you could see the market through the eyes of an institution? What if you had a framework that didn't just guess, but instead waited for powerful confirmation across different, uncorrelated layers of the market? Big money doesn't rely on just one signal. They wait for a powerful confluence of data. In this video, I'm breaking down the 3-signal Bitcoin strategy that smart money uses to get ahead of major market moves, combining technical, on-chain, and fundamental data for a crystal clear picture. This isn't about some magic indicator. It's about building a system to understand what's really happening with Bitcoin, filter out the noise, and position yourself for the moves that have the highest probability of success. This is the strategy that beats the noise. And as a quick aside, if you find this kind of deep dive analysis valuable, think about subscribing and joining our free community. We're all trying to figure out these markets together. So why do so many traders fail? It all comes down to dependency. They get hooked on a single indicator, one style of analysis, or one influencer's opinion. Maybe a trader lives and dies by the relative strength index, or RSI. When it flashes oversold, they buy. When it hits overbought, they sell. This works beautifully, until it doesn't. A market in a strong, sustained uptrend will stay overbought for weeks, and the trader who sold early is left watching in agony from the sidelines. Another trader might swear by the MACD, the moving average convergence divergence indicator. They wait for that bullish crossover to confirm a new uptrend. But in a choppy, sideways market, the MACD will flash a dozen false signals, chopping up their account with small, frustrating losses. The real problem here is a lack of context. A technical indicator is just a formula based on price and volume. It tells you what has happened, but it can't tell you why. It doesn't tell you who is buying, who is selling, or what's driving their decisions. Relying on technicals alone is like trying to understand a football game by only watching the scoreboard. You see the score change, but you have no clue about the strategy, momentum, or the key players making it happen. This is where confluence becomes a game changer. Confluence is the art of finding multiple, independent signals that all point to the same conclusion. You're building a case for a trade. Instead of trusting one witness, you're bringing in 3 credible, unrelated witnesses to back up the story. The strategy we're building today is based on this exact idea. It's a trifecta of analysis that gives you a panoramic view of the market. The technical signal. This is our trigger. It tells us price action and momentum are lining up for a potential move. The on-chain confirmation. This is our conviction. It looks under the hood at the Bitcoin network itself to see if smart, long-term holders are acting in a way that supports the technicals. The fundamental backdrop. This is our context. It gives us the long-term story and capital flows that can fuel a major trend for months or even years. When all 3 of these align, when the technicals, on-chain data, and fundamentals are all telling you the same story, the probability of a successful trade goes through the roof. You're no longer guessing. You're executing a plan based on a complete picture. This is how you go from being reactive retail to thinking like a proactive institution. Let's start with our first layer, the technical trigger. This is what first gets our attention. While some traders get lost in dozens of complex indicators, we're going to focus on the powerful and time-tested duo of the RSI and the MACD. But let's be clear, neither of these is a magic bullet. Think of them as filters for each other. The relative strength index, RSI, is a momentum oscillator. Simply put, it measures the speed and size of price changes on a scale of 0 to 100. It helps us spot potentially overbought or oversold conditions. Typically, a reading over 70 suggests the market is overbought and might be due for a pullback, while under 30 suggests it's oversold and could be ready for a bounce. But just selling at 70 and buying at 30 is a recipe for disaster in a trending market. The real power of the RSI, in my opinion, is in finding divergences. A bullish divergence happens when Bitcoin's price makes a new low, but the RSI makes a higher low. This is a clue that even though the price is dropping, the downward momentum is weakening. Sellers are getting tired. It's a subtle but powerful sign that the trend might be about to reverse. On the flip side, a bearish divergence, a higher high in price but a lower high on the RSI, warns that upward momentum is fading. Now let's bring in our second tool, the moving average convergence divergence, MACD. The MACD is a trend-following momentum indicator. It has two lines, the MACD line and the signal line, and a histogram showing the distance between them. The most basic signal is the crossover. When the MACD line crosses above the signal line, it's bullish, suggesting a new uptrend. When it crosses below, it's bearish. The MACD is great at confirming a trend once it's already moving, but it can lag and give false signals in choppy markets. This is where the synergy comes in. Here's how we combine them for our technical trigger. We don't act on an oversold RSI alone. We wait for the RSI to show us that momentum might be shifting, maybe by dipping below 30 or even better by forming a bullish divergence. That's our alert, but we don't trade yet. We then look to the MACD for confirmation. We wait for the MACD line to cross above the signal line. This combo is powerful because it covers the main weakness of each indicator. The RSI gives an early warning and the MACD confirms the trend is actually starting to turn. This process filters out a ton of false signals that you'd get using just one of them. For example, we've seen periods in late 2025 where technical analysis shows Bitcoin's MACD in a bearish zone, signaling downward momentum, while the RSI is also below the 50 level, confirming a seller-dominated market. This technical picture alone suggests caution, but it's only one of our three signals. We need more evidence. Now we leave the traditional charts behind and look directly into the Bitcoin blockchain. On-chain analysis is our secret weapon. It gives us an incredible view of what everyone on the network is doing, from the newest retail buyer to the oldest, wisest whales. It's the difference between watching the scoreboard and having a spy in the team's locker room. We're going to focus on two extremely powerful on-chain metrics. First is the realized price. This isn't the price you see on Coinbase. The realized price is the average price at which every Bitcoin in circulation was last moved. Think of it as the collective cost basis for all Bitcoin holders. It's a massive psychological level. When the spot price is above the realized price, the average holder is in profit. When it falls below, the average holder is at a loss. Historically, the realized price has been a major signpost for market cycles. Times when the spot price fell below the realized price were often moments of maximum pain and deep bear markets, but also maximum opportunity. A classic pattern in past cycles is seeing a sustainable bottom form after the spot price dips below the realized price, shakes out the weak hands, and then decisively reclaims it as support. Watching the price reclaim that level is a powerful sign that buyers are stepping back in with conviction. Our second on-chain metric is cumulative value days destroyed, CVDD. It sounds complicated, but the idea is simple. CVDD tracks the behavior of long-term experienced holders. When an old Bitcoin that hasn't moved in years is finally sold, it destroys a large number of coin days. CVDD puts a dollar value on this activity, creating a historical price floor based on the value spent by old hands. The CVDD line has often marked the absolute bottom of major bear markets throughout Bitcoin's history. It's not a perfect floor, but it's an amazing guide to where generational buying opportunities might be. Some on-chain models, by projecting its trajectory, suggest a potential long-term floor in the $80,000 range by the end of 2026. While that's just a model-based projection, not a guarantee, it gives us a data-driven anchor for where deep value might appear in a future bear cycle. For example, some analyses place the current CVDD around $45,000, a level that continuously trends upward, serving as a reference for the underlying value in the network. So, how does this become our second signal? After our technical trigger fires, RSI divergence plus MACD cross, we look for on-chain confirmation. Are the network's foundations strong? Specifically, we ask, how is the spot price interacting with the realized price? If we're in a downturn and the price firmly reclaims the realized price, it's a huge sign of strength. It shows the market has soaked up the panic selling and a new floor is being built. Where's the price in relation to the CVDD line? If the price is near or has just bounced off the CVDD line, it tells us we are in a zone that has historically been an incredible value opportunity. When the technicals are signaling a bottom and on-chain data shows we're at a historically significant value level, our case for a major trend reversal gets exponentially stronger. Recent on-chain data from late 2025, for example, has shown that as prices became volatile, metrics like the spot taker cumulative volume delta began to flip bullish, indicating aggressive buyers were stepping in on spot exchanges. That's exactly the kind of confirmation we want to see. Our first two signals give us a high-res snapshot of the market's health and momentum. But our third signal, the fundamental backdrop, determines how big and how long the next major move could be. Fundamentals are the slow-moving ocean currents that guide the market over months and years. For Bitcoin right now, the single most important fundamental driver is institutional adoption, mainly through spot Bitcoin ETFs. The approval and massive inflows into spot Bitcoin ETFs in 2024 and 2025 have completely re-engineered Bitcoin's market structure. Before, buying Bitcoin was a hassle for big institutions. Now, getting exposure is as easy as buying a stock. This unlocked a multi-trillion-dollar fire hose of capital that was stuck on the sidelines. Tracking the daily net flows into these ETFs is now one of the most critical data points for any serious Bitcoin investor. It's a transparent, real-time gauge of institutional demand. A day of large net inflows means billions of dollars of buy pressure had to hit the market as ETF issuers bought the underlying Bitcoin. We've seen days in December 2025 where total net inflows exceeded $220 million, often driven by a single dominant player like BlackRock's IBIT, which can power the market by itself. Conversely, consistent outflows can signal cooling demand or profit taking. The period after the 2024 halving has, in many traders' views, made the market even more sensitive to these flows. With the new supply of Bitcoin cut in half, the impact of this consistent ETF demand is mathematically amplified. You get a dynamic supply shock where a growing wall of institutional money is chasing a dwindling supply of new coins. This fundamental pressure is what fuels the bullish long-term price targets. While predictions vary, many analysts see sustained ETF demand as a primary driver, with some bullish outlooks for 2025-2026, targeting prices from $120,000 to over $200,000, assuming the institutional flows keep coming. So our third signal is an assessment of this fundamental environment. When our technical trigger fires and our on-chain data confirms strength, we look at the fundamentals and ask, are the capital flows there to support a sustained move? A green light here would be a period of consistent, strong net inflows into the spot Bitcoin ETFs. Even during a price dip, seeing institutional players buy the dip through ETFs is an incredibly strong sign that the long-term bull case is intact. If the technicals are turning up, on-chain data shows a bottom forming, and the ETF flows are positive, all three signals are aligned. The stars have aligned. This is the trifecta, a high-confidence setup for a major market move. Let's walk through a hypothetical but realistic case study based on the market of late 2025. Imagine it's a few months back. Bitcoin has just seen a nasty correction from its all-time high of over $126,000. The mood is terrible. The fear and greed index is flashing extreme fear, and people are calling for a deep bear market. The price has just dropped to a new local low, let's say around $90,000. Step one, the first glimmer of hope. A single indicator trader might be panicking, but as a three-signal strategist, you're patiently watching. You look at your chart. Price just hit that new low at $90,000. But you spot something on your RSI. While the price made a lower low, the RSI printed a higher low. Signal 1, part 1, a clear bullish divergence. That's your first alert. Selling pressure is running out of steam. You don't buy yet. You wait. A week goes by. Price chops sideways. Then you see it. On the daily chart, the MACD line curls upwards and finally crosses above its signal line. Signal 1, part 2. The MACD gives a bullish crossover. Your full technical trigger is now active. The scoreboard is starting to flip. Step 2, looking under the hood, on-chain confirmation. Now you move to signal number 2. You check your on-chain data. You see that the drop to $90,000 pushed the price closer to a major psychological floor, like the aggregate cost basis for spot Bitcoin ETFs, which some analysts place around $80,000. This move caused panic and liquidations, but in the weeks that followed, as your technical signal formed, the price fought its way back up and is now trading firmly above $92,000, which is starting to act as support. Signal 2, part 1. A key psychological price level has been reclaimed. This tells you the market absorbed the panic and a new floor of conviction is building. You then check the CVDD line. You notice that the recent lows were approaching a zone that historically represents a valuation floor, reinforcing the idea of a bottom forming. Signal 2, part 2. The price found support near a historically significant valuation zone. The network's foundation held strong right where you'd hope it would. Step 3, checking the capital flows. Fundamental backdrop. You're now 2 for 2. Technicals are bullish and on-chain data is strong. Time for the final signal, fundamentals. You pull up the spot Bitcoin ETF data. During the price dip, there were some outflows, but nothing catastrophic. More importantly, as the price stabilized and reclaimed key levels, the flows turned positive again. You see a consistent pattern of net inflows. maybe $50 million one day, $200 million the next. BlackRock and other big players are buying. Signal 3, institutional demand is persistent. The big money isn't selling, they are accumulating on weakness. This is the moment. Your technicals are flashing green, your on-chain data confirms it, and the fundamental flows are providing the fuel. The three signals are in perfect confluence. This is your high confidence entry point. A strategy is nothing without rules. Let's make this official. Entry signal, technical, a bullish divergence on the daily RSI, followed by a bullish crossover on the daily MACD. On-chain, the Bitcoin spot price decisively reclaims a key psychological level like the realized price after trading below or near it. Fundamental, net inflows into spot Bitcoin ETFs are consistently positive, confirming institutional buying. Exit signal, profit taking. You can set profit targets using key resistance levels or Fibonacci extensions from the prior move. A sign to consider taking some profits could be a bearish divergence on the RSI. Price makes a new high, RSI makes a lower high, while the market is showing extreme greed. Stop loss. Always use a stop loss. It should be placed below the key level that confirmed your trade. In our case study, a logical stop loss would be a daily candle close back below the reclaimed support level, like the realized price, as that would invalidate our on-chain thesis. Risk management is everything. No strategy is foolproof. The goal here isn't to be right every single time, but to stack the odds in your favor and make sure your winning trades are much bigger than your losing ones. Putting a system like this together takes time and a solid grasp of the data. If you want to get deeper insights into how these metrics are changing week by week and get analysis just like this sent straight to your inbox, I highly recommend signing up for my free newsletter. It's where I share my most up-to-date thoughts on the market, totally free. The link is in the description below. As we stand here in late 2025, the market is a complex and often confusing place. We have technical indicators suggesting bearish sentiment at times, with the MACD and RSI below neutral levels on certain time frames. The Crypto Fear and Greed Index has recently spent time in fear and extreme fear, with readings dipping into the 20s. At the same time, the fundamental engine of institutional adoption continues to pour capital into Bitcoin, with ETF flows providing a constant source of buy pressure. Relying on any one of these signals alone would give you a dangerously incomplete picture. A pure technical trader might be bearish, a fundamental analyst might be wildly bullish, an on-chain analyst might be somewhere in between. But by combining them into a single, cohesive framework, our trifecta of technicals, on-chain data, and fundamentals, you can finally cut through the noise. You can see how short-term weakness might actually be a long-term opportunity. You can see when institutional buyers are stepping in to absorb retail fear. And you can wait with patience and discipline for that perfect moment when all the stars align. This is the strategy that gives you a clearer picture. This is the strategy that helps you anticipate, not just react. This is how you start trading with the confidence of an institution, beat the noise, and prepare for whatever comes next.